Welcome, everyone. Today, my guest is Managing Editor James Kleimann to talk about HUD's cut to the mortgage insurance premium and the continued layoffs at Wells Fargo. James, welcome back to the podcast.
Hey, good to be back. It's been 2 days, right? 3 days, like that.
We missed you. We had to have you back right away.
That's right.
Well, we have some really interesting things to talk about. So I would say first on my list is the FHA MIP change that we saw this week, which has been debated and people have really strong feelings about. Tell us what happened and what the effects are.
Yeah, this is a big one. So HUD/the FHA and Vice President Kamala Harris on Wednesday announced that the agency would be reducing annual premiums for borrowers and homebuyers. And industry trade groups have been pretty much begging the FHA to do this for more than 2 years. And their argument is essentially, look, affordability is at maybe the worst level in modern American history. And by reducing that annual MIP, the mortgage insurance premium, they can provide real life savings to existing borrowers with, an FHA insured mortgage. And of course, those who are also looking to buy a home with an FHA backed mortgage. And those buyers tend to be minorities who have lower income, worse credit, and have largely been shut out of the housing market over the last few years. According to the White House, more than 80% of FHA borrowers are first-time home buyers, and over 25% are home buyers of color. So, the average home purchased with an FHA insured mortgage typically costs around half the price of the overall national median home. And these are very often, these are not $1 million homes. They typically, the average mortgage is less than $270,000 on an FHA home. And so what the FHA has essentially done here is they've reduced the annual fee to 55 basis points. And that is down from 85 basis points. And we haven't seen a cut like this since, I want to say it was January 2015 when the Obama administration reduced premiums to roughly the same level. I think they cut 50 basis points back in 2015. And of course, as the old timers may remember, that cut was pretty short lived. It was rolled back pretty quickly after it was instituted. But moving forward, so by reducing the fee to what is essentially 0.3% of the mortgage, the government is saying, look, the average borrower is going to save about $70 a month, and that's roughly about $800 this year alone in 2023. And the White House says this is going to benefit roughly 850,000 borrowers and prospective, FHA home buyers. And so they offered a few examples. The first is, let's say you're a family and you want to buy a home in Detroit, and you're going to get a $200,000 mortgage. You're going to save about $600 a year. Or let's say you're in Cincinnati and you have a $300,000 mortgage. You're going to save about $900 a year. Or if you're in Phoenix and you're not an iBuyer, I guess, and you have a $400,000 mortgage, you would save roughly $1,200 a year. And in the most extreme example that they offered, let's say you're a family, you're buying a home in Austin, Texas. We know the crazy Wild West of Austin and its housing market, and you want to get a $500,000 mortgage, you're going to save about $1,500 a year. So real savings, right? If you're among this relatively small group of people who might benefit, I don't want to kind of understate how important that means for someone who is struggling with inflation and just general rising costs in America. But we're not talking about millions and millions of borrowers. The FHA segment of the market is relatively small. It's, I think in the last quarter, it was about 14% of origination volume. So they're still very secondary to the impact that the GSEs, Fannie and Freddie, have in the market. But, for people who could be saving $1,500 a year, that's a lot of money. That's real money. Now, in terms of overall impact, I don't want to say that this is a huge deal. I know that mortgage trade groups have been publicly clamoring for this for years now. And because of the way that the FHA operates, that they have to go through the congressional budget process, they basically couldn't get this off the ground until recently. And the way it works is they have the MMI, which is essentially like a capital backstop at the FHA. And it finally reached a level that administrators and, top policy folks in the Biden administration felt was comfortable, right? So it reached 11.11%, I want to say in November, and that is more than 5 times the statutory limit of it's 2.0%. Now, a lot of people think that's actually really low considering the risk, but we can get back into that in a minute. So the argument in favor of doing this is essentially, look, there's plenty of money in this fund if the economy falters and home values drop, which they've been doing over the past year.
Well, I think it's really interesting because like you said, this is something we've been paying attention to. And so this was something that was announced at the MBA Servicing Conference, which is going on right now. And I really thought it was funny that, FHA Commissioner Julia Gordon started off by saying, the great news is that no longer your first question to me in any forum has to be, when are you going to reduce the mortgage insurance premium on FHA mortgages? And I'm sure that, like you said, it's been a very laborious process going through Congress. But also, you have people who feel like the risk, doing this is a risky move, and then you have other people who are like, this is this is a no-brainer, it's good for homeowners. So I agree with you that we don't want to downplay that this could make a big difference for some homeowners. As far as the mortgage industry at large, this is not going to move the needle, unfortunately, very much for people who maybe it's not like going to offset what we're seeing, for instance, in mortgage rates.
Right. And we're also not going to see a big transition from people who otherwise would have maybe gotten, conventional mortgages. And suddenly now the pricing is so good on FHA products that they're going to jump over to that. Right. This is not that it was the goal or the aim or anything like that. But yeah, look, depending on who you talk to, it's either a very sensible plan that doesn't go far enough in addressing the very real challenges of affordability right now, or it's an undue risk, and it's really a minor political victory for the Biden administration to say, look at what we're doing. We're making it easier on people who are down on their luck or just struggling to make ends meet. And I think it's probably somewhere between the two, as it tends to be in this universe. The reality is it is not a plan without risk. And I think even Julia Gordon acknowledges that, even if there is a fair amount in capital reserves. And it's important, in my view, to think about the FHA's mission. The FHA views itself as an entity that is providing housing finance options for those who are not currently being served by the market, right? It's an alternative to Fannie Mae and Freddie Mac, or other forms of housing finance that we don't need to get into for the purposes of this conversation. Now, Fannie and Freddie are, depending on the quarter, roughly 2/3, sometimes more, sometimes a little bit less, of the mortgage market. And they have very narrow credit boxes. This has been a complaint of affordable housing advocates and policy experts for years now. And Fannie and Freddie are not really set up to serve borrowers at the lower rungs of the housing ladder. That is squarely in the FHA's remit. Now, when you look at the FHA's own data, I think it's very clear that there is some risk. They do have a quasi-risk-based model, right? And they have a fee structure that is part of that. And so there's an upfront fee, but most of the borrowers are going to opt to finance that into the loan. And so if home values do drop, there's risk in that upfront fee not being collected, right? And then we can also get into the annual insurance, which is what the FHA is cutting from 85 basis points to 55 basis points. That number is set by HUD. And if it's not at a sufficient level, the MMI fund, right, taxpayer funded, will have to cover, whatever borrower defaults end up numbering. And while I don't want to pretend like there's a tremendous amount of risk in the housing market right now in terms of defaults, they're not, right? Like, remember when the pandemic was very much at the apex, and we saw, 11, 12% of borrowers in distress on the FHA side. You don't see that now. It's less than half that. And it doesn't mean that there's not risk, and conventional borrowers, their forbearance rates, their default rates are way, 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 way lower. So if you look at, let's say, a first-time home buyer, and they have a 95% LTV and a sub 680 FICO score, 3/4 of those borrowers are going to get FHA loans. They're not getting conventional mortgage products. And more than 60% of FHA borrowers have a DTI over 43%. So you have a lot of borrowers out there who, in the words of certain people in the industry, like, don't have a lot of skin in the game, and they don't have much of a cushion if something goes wrong. And so if the economy falters, or say the housing market drops another few percentage points in value, you're looking at potentially a couple 100,000 borrowers in distress. And while we have a lot more tools in terms of the loss mitigation waterfall, um, and other major factors I think that are more fundamental here, right? Like the lack of housing inventory will always keep prices a little bit higher just because, it's simple supply and demand, right? But the Biden administration, I think, really wants to avoid uh, poor homeowners in America being forced into the rental market. So yes, there's risk. I think we have a better system overall set up to mitigate that risk right now.
I think that's so true. And I think that it's worth noting that even people getting FHA loans, I mean, the underwriting is pretty strict. Like you said, you talked about, what they have to show, what they have to do that. So I don't feel like this is combined with like a real easing of lending standards. And that's been the case for people who say, the risk is less than what some people say, because just in general, credit standards, even for FHA, it's not like we're just letting anybody buy a home.
Right. And the FHA was very much singled out as really fueling the subprime crisis. And I think policymakers in the Biden administration are very aware that you don't want the goals of equality and housing equity to overshadow the potential risk there. And so cutting the MMI annual premium from 85 basis points to 55 basis points is not that big. It's lower than a lot of people actually wanted. There are a lot of people out there writing op-eds and getting on their soapboxes and saying the FHA could absolutely take a 50 basis point cut if they wanted to and have plenty of money in the MMI to cover any potential losses should there be any. They didn't end up doing that. And I think you're going to find as many people who are unhappy with the size of the cut on both sides, right? So people who think that this was too risky and people who think this just doesn't go far enough. And it speaks to the balancing act that the Biden administration really has to weigh, and that they've made it very clear over the last month or two that they're prioritizing those inequities that they see in the housing market, and even look at, the bigger brothers to brother and sister, I guess, to the FHA in Fannie and Freddie, right? So the FHA recently made big LLPA changes by essentially reducing or eliminating upfront fees for first-time homebuyers and those with lower credit scores. And this was seen by a lot of people in the industry as Fannie and Freddie, one, competing with the FHA for borrowers who are kind of in between the two federal programs, right? And then they're also implementing a big fee on DTI levels, which they'd never done before. And so a lot of people are saying, look, you're now essentially taking, you're throwing out like the true risk pricing system out the window, and you're using it to subsidize borrowers with worse credit and in most cases lower incomes. But again, like this is actually pretty consistent with the overall policies of the administration. They have made, a very concerted effort to push Fannie and Freddie to make strides with underserved borrowers, especially in communities of color. The FHA has always checked that box, but now, the share of agency borrowers has grown, and there's a lot more political pressure to make sure that they are delivering, in non suburban and wealthy communities where a good percentage of the borrowers don't have any trouble qualifying. So, when you talk to people in the industry, there are a lot of consumer advocates that wanted cuts to the FHA's upfront MIP, which is a little bit different, right? And also changes to its life of loan policy, which requires continued insurance payments regardless of how much equity the homeowner has. And their argument is, look, that makes a much bigger impact than a 30 basis point cut to an annual fee. And, others said, hey, why not just take this big capital reserve fund that you say is so strong and can protect us from whatever headwinds are there? Why don't you use that toward like a down payment assistance program that is hyper targeted, right? Because that's one of the major issues for FHL borrowers is you're getting a 95% LTV because who has $100,000 in savings that they can throw at, at a down payment for a house, right? And so I think there are other approaches, and no one is ever going to be fully happy with government policy of any stripe, right? But I think you'll find that there are just as many people who think it's okay, it's fine, but could have been stronger, and those who say, why are you taking risk right now with a looming recession? And when we're seeing home values drop in, housing markets across America, like what's to save people $70 a month? Like, what are they going to do? Buy more eggs? Like, is this really a good policy? And it's certainly debatable.
I do think that down payment assistance portion of this is so important because you have people who are paying a lot of money in rent, and sometimes in some areas in the little suburb north of Dallas Fort Worth where I've lived a lot of my life, it's definitely better to buy than rent. You're going to be paying, if you can afford a modest down payment, you are going to be paying less in mortgage than you are in rent. Of course, that's not true everywhere, right? But you do
Sure.
see like the difference between people who have a great rental history, have been able to afford their rent, have never been late on their rent for years, and people who can afford a house. It's really the down payment. And of course, the whole argument against that is, well, you don't have enough skin in the game if you're getting down payment assistance. But again, I just feel like there are other ways to mitigate that. And to your point, what is the $70 a month? But I know that people cheered it. I know that people have been asking for it. I do think it's interesting to see Fannie and Freddie sort of, they're already competitors with each other. They are very competitive with each other. They think it's an integral part of their mission that they are, and there's that's a good thing for the market, that there's two of them, two government sponsored enterprises. Interesting to see them sort of go after that FHA borrower a little bit more.
Yeah. And I don't think that they would, that the FHA certainly doesn't want, to be thought of as competing with
Right.
Fannie and Freddie. They don't view that as part of their mission. I think it happens to be where this just sort of collides with policy. And if you're a borrower, these are the choices, for getting a mortgage, because you're trying to serve a population that just doesn't have that kind of cash. Like there's, they don't have the means to do it without a mortgage. And yeah, I do think it's going to be really interesting also for participants in the market, because we have larger questions about, the risk-weighted capital from Ginnie Mae that's been, debated. I would say a lot of participants in the mortgage market are very upset with that. The new DTI changes that we spoke about with the LLPAs for Fannie and Freddie. These are much more impactful on the operational side of mortgage lending and the insurers as well. And so it's more difficult now to run a mortgage company, I would argue, than probably, any time in the last 15 years. And they say, like, we're hamstrung by regulation. We're hamstrung by all of these compliance requirements. And if you don't start streamlining some of these mandates and making it more achievable, we're going to continue to see mortgage costs increase regardless of, these kind of what they would consider small measures to help with affordability.
Which segues directly into the next story I wanted to talk about, which was more layoffs at Wells Fargo, which is obviously not just a mortgage company, but a depository bank, but that seems to want to get out of the mortgage business. That seems to be one of their things that they want to do. So they had another round of layoffs this week. Tell us about that.
Yeah, so we confirmed that Wells Fargo did in fact lay off a large number of workers in their home lending division. They wouldn't confirm the number. Sources have told the newsroom that it's more than 1,000 people. And Wells Fargo has been making cuts every quarter for, a minimum a year and a half now. So no one would be surprised by this. But again, it does signify that Wells Fargo is very serious about getting out of this market, in a controlled fashion. Wells Fargo doesn't want to fully exit mortgage. They want to be much smaller. They want to be able to serve their own client base. And then they also want to make the federal government and its various regulators a little bit happier about its position in, addressing, again, some of these inequities in housing. And so they have a special purpose credit program that they're tweaking right now. And that's really designed to improve the optionality for prospective borrowers. And, right now it's just a handful of communities. But, these are not loans that they're selling. These are not Fannie Freddie loans. These are not jumbos. I think in a lot of cases, these are loans that they're going to be making to homeowners on the lower end of the income spectrum, because that's part of the it's part of the game when you're, facing billions of dollars in fines. You got to make the government happy. And what does the government want? They want you to be showing that you can lend to communities that have been underserved, by you and by others. Like Wells Fargo is not the only bank that is, I think, maybe shirked its responsibility in lending in urban areas. And the banks will tell you, you made it too hard for us. That's where we're not there. But at the end of the day, I don't think really the government cares about the reason. It's the reality that if you're, a low income homeowner in Baltimore, you don't have a lot of great options. And the fact that your bank is not actually participating in this kind of market means wealth is not accumulating at the rate that you would want. So that's where Wells Fargo is. We also have been hearing for some time now that they might be trying to dump a huge amount of MSRs, mortgage servicing rights. And it's all rumors at this point, but it has shaken up the markets. The MSR market has been all over the place. It's been extremely volatile because, it's not really designed to absorb, let's say, just throwing numbers out there, a package of 80 billion in MSRs, and then another big package of maybe another 50 billion in MSRs, right? And so, Wells Fargo is such a big player. They're the largest servicer in America. They've got nearly $1 trillion in servicing. And if they're going to make major moves, whether it be on the origination side or the servicing side, that's going to have major downstream effects on every other lender, every other servicer out there. And that's going to be a benefit to some of them, right? Like if you're Penny Mac, you're probably thrilled that one on the servicing side, now you have more, potential options there. And in correspondent, where, you often lost jumbo originations to a bank like Wells Fargo, you don't have that competition anymore. And so, some are going to be happy about some of this, and others are going to be really challenged by what happens, especially a lot of, non-banks that are in the origination space. They get affected by the implications of the secondary market if they can't sell, their MSRs at par, because there's all this chaos in the secondary side of things and the pricing is just not good. Then, well, they have to have enough money to keep, the operations humming. And it's just, it means that if you're smaller and not as well positioned, you have fewer options. And the fewer options you have, the longer this cycle goes, where we're looking at rates in the mid sixes, high sixes, low sevens, maybe, the harder it becomes. And it's just, it's kind of a death spiral at that point.
It really is. And, you and I have talked a lot about, big depository banks and their appetite or not for mortgages over the last year. And I think this is so interesting that, as you said, their strategy is existing customers. So they really cut different loan originators who weren't tied to their branch offices, right? So the branches are where you're meeting your local community. It's also where you have the fair lending standard of you need to be meeting the mortgage needs of those communities. So in some ways, I mean, if you're going to do any mortgages at all, if you're a depository bank, which you have to for your existing customers, I mean, it's part of what you need to do. You have to be focusing on those communities because that's what you're being held accountable for. Are you serving those communities?
Yeah. And look, I don't see any reason to think that we're going to see depository banks get back into the FHA Ginnie space. There's no interest, among the people that I talk to of getting back in there, even if they tried to make it a little bit easier. It's just, I think they would rather route things through these special purpose credit programs where, I mean, they have the largesse. It's not like if just as a hypothetical, JP Morgan Chase decided, okay, instead of trying to do FHA lending and dealing with all the headache that comes with that and the underwriting challenge and, maybe even buying loans, that are FHA, why don't we just set up a few branches in, again, just by way of example, because I used it earlier, in Baltimore. And we're going to develop programs where maybe we help them with, a down payment. Maybe we don't need, all of the risk modeling that is typically associated with loans that you're selling to the government, right? And you keep it on the books and you limit your potential losses to, whatever the bank executives deem is appropriate. Let's say $100 million, right? and you build it that way. And that's a way to engender a sense with the U.S. government that you're making a good faith effort to lend in those communities. And by the way, those communities actually do need lending. It's not, I think there's a huge benefit in having your retail bank that you do your personal or maybe business banking with, and also provides you the mortgage option for your home, right? I mean, that could be really smart. Maybe you have a financial advisor through that bank who can help you with all three, right? But when you're breaking it up piecemeal and that forces you to go to, say, a Rocket or a Loan Depot or a UWM, they don't see the full picture of your life. They don't see, there's no continuity with the other, financial positions that you're in. And so I think it would be a huge benefit if we had banks getting back into the inner cities. There is, we talk about food deserts. There are banking deserts in huge parts of urban America. And there's no reason that banks that are printing money cannot have a presence in those areas.
It's a really great point. And I feel like, if you're Wells Fargo, if you're Chase, if you're one of these big banks, you're really looking at like, what's the risk? What's the reward? There's so little reward in mortgage right now that, part of this is not monetary, but like you said, just staying on the good side of regulators, making a good faith effort. I thought it was interesting. CNBC reported that some of those people that were laid off had been part of, they got to go on the top producing trip that, for those who surpassed 100 million in loan volumes last year. So it's so interesting. I mean, it's not just like, oh, they're cutting the people who are doing a good job. I mean, they're really just changing their model.
Yeah, you know what they're doing. So a lot of these top producers, first, a huge amount of them have already left. I mean, I would say the vast majority of big fish in terms of LOs at Wells Fargo, they left more than a year ago. And that's partly because, the way that Wells Fargo responded to all of these regulatory challenges was being very, I want to say kind of like surveillance statey with some of their employees. I mean, a lot of monitoring, a lot of restrictions, very little freedom. They didn't want to do a lot of cross sales on products. It became a very different game. But a lot of people who work in private wealth and mortgage can make a ton of money, right? Because as I've said, Wells Fargo was the jumbo lender in America for a very long time, and their pricing was so much better than anyone else. They could keep it on their balance sheet. It didn't matter. They have a huge presence in Northern California, big presence in a lot of wealthy urban areas. New York, they do a lot of business, in New York, doing condos and all kinds of jumbo loans, right? And so the folks that are still there, or until recently were still there, they're now on the market, and they're going to be hot commodities because the lifeblood of mortgage lending is still sales, right? I mean, nobody's cracked the algorithm code better, never quite got off the ground in terms of figuring out how to do purchase with kind of a non-commission based model. It's still eat what you kill. And if you have people who have those connections with real estate agents and wealth advisors and, others who can bring you the leads, that's still a really, really, really valuable commodity for a mortgage lender who more than ever now needs to make it work in the originations landscape. And retail lending was down in the fourth quarter pretty significantly because retail, traditionally relies more on tapping its servicing, network to mine for leads, and you have to be purchase focused. And yeah, I think Wells Fargo is letting a lot of good people go, and that's going to be great news for the guaranteed rates and even the brokerages that are doing comparably pretty well right now. They're going to be ready. And if you're entrepreneurial and you want to run your own team, you want to run business as you see fit, that might be a really attractive landing place.
I love that. I can't believe we're already out of time. We had a bunch of other things I wanted to talk to you about, so we'll just have to have you on again very quickly. But James, thanks so much for talking today.
Thanks for having me, Sarah.